Hi everybody, welcome to our DAT IQ Weekly Market Update. This is our update for May 20, episode 340. I'm Dean Croak, Market Analyst here at DAT, along with co-host Chad Kennedy. No guest today, but Chad, welcome to the show. Good to see you again.
Yeah, thanks, Dean. You've got a new background there. You're in the desert.
Yeah, we're at DAT Symposium here in the Boulders, just Scottsdale technically, but it's up in the Sonoran Desert. It's just beautiful up here. Each day it's about 80 degrees. It's been near 100 people here this week, so it's going to be a fantastic event.
Sounds wonderful. 80 degrees and dry. We're bumping 90 degrees here in Florida, up over it. Hit 95 over the weekend. It's feeling like summer.
Is this sort of getting to the point where people start to leave because of the humidity?
Yeah, it sure is. Yeah, around Mother's Day, they'll go back home. The snowbirds go back home. Yeah, so the humidity will start to really sink in next month. But
Okay. All right, a lot to get through today. We'll bring you back in a little bit later, Chad, and talk about the contract market and dive into some of the trends there. We'll talk a little bit more about Road Check Week, but of course that was one of the key market trends we're watching this week. Road Check Week, very evident last week. Spot market, capacity crunch, rates spike. We'll dig into that a little bit later. What we saw in our equipment post, we saw about a 14% week-over-week drop in equipment posts versus the long-term average of 8%. 14% is not unusual for any road check week where you see anything to do with drivers' credentials or the authorities being inside the cab of a truck as it relates to things like hours of service, paperwork, ghost drivers, etc. So nothing unusual there. Fairly well in line with other road check week drops in equipment posts where drivers have been the focus. Bill Cassidy's truckload capacity index came out last week. Large truckload carriers on the public company side continue to reduce capacity. Response to weak freight demand were the lowest since 2014. Big fleets like Landstar cut their fleets down about 8.4% year over year. Imports, we'll talk a bit about that later, but April 25 import volumes as measured by 20-foot equivalent units, down about 0.7% month over month, so essentially flat, but up about 14.4% year over year. It was the second highest ever recorded for April on the import front, and sort of wraps up about 7 or 8 months of very high super seasonal activity on the import front as shippers have been pulling forward a lot of import volume. Housing, some worrying trends came out last week from the US Census Bureau. US single-family home building starts and permits driven by persistent tariffs on imported materials and very high mortgage rates have been creating substantial roadblocks for the housing market. That persisted in April. Single-family housing starts total about 927,000, down 2.1% in April, but almost 11% lower year over year for truckload carriers. That's the equivalent of hauling 83,000 fewer truckloads last month compared to April last year. This week's market update will be out this evening at dat.com/market update. We're looking in depth at the LMI, the Logistics Managers Index from Zach Rogers for April, the California strawberry season, and the latest from the Census Bureau, digging a little bit more deeper into the residential construction data that we just covered. Let's start with the dry van market and have a look at load posts as a result of road check week. Dry van load post volumes hit a 4-year high last week, up 42% as brokers sought to find trucks to move slightly higher volume. Carriers' time off last week resulted in an 11% drop in equipment posts on the dry van side. Load to truck ratio ended the week at 7.43, up about 60%. In the refrigerated market, load post volumes were up 40% last week, the highest for week 20 in 4 years. We had a 2% week-over-week increase in produce, so that boosted some of the volume, but really the change in load-to-truck ratio was driven by the capacity shortage during road check week. Load-to-truck ratio ended the week at 15.83. That's a 9-year high for week 20 on the load-to-truck ratio. And in flatbed, significant capacity drop last week. Equipment post down 20% in flatbed. Load securement was one of the areas that Road Check Week was focusing on. Of course, in flatbed, that's incredibly evident, given they can see the load securement firsthand. This led to an 11% rise in flatbed load posts, a 40% jump in the flatbed load to truck ratio to 41.01. Having a look at our year-over-year look at spot rates, the CVSA safety blitz last week really caused an acute capacity shortage in dry van. Spot rates up 10 cents a mile to $1.70. That's 8 cents a mile higher than last year, and also the highest in about 3 years for week 20. In our Midwest region, where we see about 45% of our loads moved, it's got the highest correlation to the national spot rate. It's kind of our bellwether states. Rates up 13 cents a mile last week. Even though volumes were down about 2%, carriers were paid an average of $1.85. That was 15 cents a mile higher than the national average. In flatbed, the CVSA safety blitz caused a major crunch in the reefer market. Chad and I'll talk a little bit about some of the reasons why it affects reefer and flatbed more. In the reefer sector, spot rates are up 14 cents a mile. That's the highest for week 20 in 3 years also. National average reefer spot rate ended last week at $2.05, excluding fuel, about 6 cents a mile above last year. And in flatbed, there was a unique capacity crunch there, of course, as we just mentioned. 6 cent per mile increase in spot rates last week. The national average reached an average of $2.21. That's up 16 cents a mile higher than last year, and also the highest in 3 years. Let's have a quick look at our short-term forecasts for the next 35 days. This is what Ratecast is telling us in green. It's predicting what rate view will be 35 days out, taking us to about June 21. Of course, this more heavily weights long-term seasonal trends. The forecast, as you can see on the chart, is bounded by the upper and lower forward-looking error bands in yellow and red. The blue line is, of course, the 7-day weighted moving average of historical rates for loads moved over 550 miles, excluding fuel, so line haul only. In dry van, we're seeing a continuation of some pretty optimistic forecasting, a little bit more optimistic than last week. Ratecast is expecting rates up 6 cents a mile to $1.77, pretty much a continuation of what we saw with the spike in rates this week, certainly out to the middle of June. When we get to the middle of June, we're going to see rates at about $1.77 a mile, according to Ratecast. That'll have them 11 cents per mile higher than last year. And in the refrigerated market, similar trend. Ratecast is expecting rates to rise about 2 cents a mile to $2.07, continuing the trend from this week. It'll end the 35-day forecast on June 21, about 5 cents a mile lower than this time last year. I think Ratecast is starting to pick up on some of the lower MCI data that we're seeing, particularly in California, around lower produce volumes, sitting at about 8% lower year over year. So normally we'd expect that green line to be continuing flat to certainly up, not downwards towards the end of this forecast. So I think produce is putting a drag on those charts, but of course the three models are in agreement there. In flatbed, Ratecast is expecting rates up 4 cents a mile out to June 21, continuing the plateauing of rates that we typically see about this time of the year. By June 21, Ratecast is expecting rates at $2.25. That'll have rates up an amazing 23 cents a mile year over year, continuing the very strong market that we've been seeing in the spot market for flatbed carriers so far. All right, Chad, that's the spot market. What are you seeing over in the contract market?
Yep. Thanks. As a reminder, everything I'll go through here is from a shipper to carrier and broker perspective, whereas what Dean just covered is from a broker to carrier perspective in spot. So looking at the spot premium ratio in yellow for dry van, going back to 2016, you can see that boom and bust cycle. And in the most recent reading here is negative 14%. This is the premium for spot rates compared to contract rates. So we're seeing spot rates 14% below contract rates from a shipper perspective. This is depressed. You're seeing a lot of that seasonal pattern over the last couple of years, since the market's been pretty soft for about 2.5 years now. This is the lowest result since August of 2023. So as you look at the new rate differential, which is the percentage difference between new contract rates and those rates that they replaced, we're at 0.6%. Last week, we reported a negative new rate differential. That's trued up and been adjusted. It's now positive 1.2% this week. As more data has come in, we've revised those numbers. So it's just right now at 0.6%, just barely positive. And contract rate, as you can see, pretty flat there. I'll report out on some year-over-year trends in just a minute here. If we move on to reefer, that spot premium ratio at negative 9.9%. And you can see those seasonal patterns leading up to it. New rate differential at 1.5%. Back to the spot premium ratio, that's the lowest since May 2024, when we were at negative 17% a couple weeks back. New rate differential came in last week at one of the highest readings that we've had since June of 2022. And then finally, we've got rate per mile readings here from shippers for dry van, temp control, and flatbed. You can see that relationship between contract rates and spot rates that we're reporting in that spot premium ratio. I have a few extra bonus slides for you this week, reporting out, if we zoom way out to the quarterly level for dry van inflation year over year, Q2 to date. So we're about halfway through Q2, which runs April to June. Contract rates, we're seeing inflation of 1.2%. If we look back to Q3, Q4, this is about what we were expecting from a contract perspective. We've had 3 quarters now of contract inflation around the 1% inflation mark. Spot rates for the quarter to date, flat year over year, just at 0%. And then when you combine everything that our shippers are procuring, contract and spot, it's right at 1.2%. And that includes the mix of spot and contract volumes. Spot volumes right now are the same year over year at 15% for dry van. Next is refrigerated inflation year over year, Q2 to date. We're looking at contract down negative 0.7% and spot rates flat. So the combined negative 0.7%. The mix of spot volumes is the same year over year. Actually up year over year from 12% to 15% this year, increase in spot usage for the quarter so far. Q4 had a slight inflation read, but it's been flat since then. That was the first inflation read that we had seen since July of 2022. On flatbed, we've got contract rates down 1.5%, spot flat year over year. When you combine everything up, our shippers are buying at a deflation of 1%, negative 1% inflation read. The mix of spot volumes is the same year over year, or slightly up, year over year from 24% up now to 29%. And then finally on intermodal, we don't report out on spot. It's a very small fraction of what we receive from our shippers. We're at contract rate increase of 1%. This is the first quarterly read of inflation since Q1 2023. So that's a wrap on contract rates, Dean.
Yeah, Chad, I was looking at a proprietary truckload demand indicator last week. It's a survey of shippers, essentially, and it was talking about near-term freight outlook. It improved significantly in the last couple of weeks, but shipper confidence is sort of, on this survey anyway, is still below where it's been in the last few freight recessions, but it jumped noticeably in the last couple of weeks. And I'm wondering if we're starting to see some optimism on the shipper front, and possibly some of that relates to where you're seeing contract rates up slightly, and maybe shippers are starting to think about losing some of the pricing power they've had, or is that sort of a bit of a mixed signal, and we're not really sure about where this market's going to head?
I think what I'm picking up from shippers that we're talking to is contract rates are playing out about as we expected this year, up about 1 percentage point. I think we thought 1 to 2%, maybe 1% in the first half, 2% in the second half. And that appears to be what we're seeing. These are not only long-term contract rates, but they're advanced. They're negotiated far in advance. Often these large enterprise shippers are negotiating these rates 6 months in advance. So a lot less sensitive to the market. Where it really starts to change is if routing guide leakage starts to come into play, and then they take these contract rate inflation, which is really routing guide leakage. They're going from that least cost carrier down to that higher cost carrier as the routing guide starts to leak out. So I think that kind of the more of the surprise this year has been how soft the spot market has been. And so I think, as we move into Father's Day, as the ports start to pick up, that'll be pretty telling to see how the rest of the year is going to shake out.
Yeah, we're certainly seeing very high levels of tender acceptance. The FreightWaves tender rejection index is sort of mapping what we see in the spot rate movement, fairly flat to moving sideways in dry van, historically high levels of tender acceptance, but different for reefer and much higher rejection rates for flatbed, which is where we're seeing some of the rates. So
yeah, that makes sense.
We're not seeing any major collapse in routing guides on the dry van front in particular.
Yeah. So Dean, I was interested in your reporting on the road check. Can you tell me a little bit about what that looks like on the road? Or Drivers it looks like we lost about 10% of capacity. Is that what your read was? And how do drivers think about taking off for that week? And we've got a holiday week coming up.
Yeah. One of the trends we've seen is that whenever there's a focus on driver credentials, hours of service, people nosing around their home, i.e. their cab, they tend to take more time off.
Sure.
So again, there's a pattern over the last decade where if it's just things like brakes or airline connectors and things like that, you see not as many people take time off because they're essential items that you keep an eye on. But when it comes to paperwork this year, of course, they've had a lot more focus on things like ghost drivers, where drivers have been reporting other drivers driving even when there's no other driver in the cab. So sort of claiming there's a team driver in the cab, but when there isn't one. So paperwork is a big part of that, and being asked to justify that sort of level of information. So it's fairly invasive. It takes a lot of time. If you've got a highway, for example, like coming out of California on I-15 or I-40 or I-80 up near Truckee, where there's limited in and out of the state, when they set up their operations, it can result in a substantial delay.
Sure.
You often see produce companies, growers and brokers advise of a 24-hour delay on shipments out of California because of road check week. So it's nothing. I mean, I've been through one, and it was a 6-hour delay.
Oh, wow. So
it took 6 hours. By the time you got off the road, through the parking area, the rest area, and then the level 1 inspection was conducted. So it can be very lengthy. So I think that's one of the main reasons when I talk to carriers. It's not that they have bad equipment that some people will focus on as the reason. It's more the time, because in the ELD environment, that half a day can mean you lose a complete leg of your trip, like you're out of sequence.
Wow, so that counts as driving time.
Yeah, you're on. Yeah, because you're in there in front of them, like they can see what you're recording on your ELD device. So you're technically on duty.
Wow.
And even if you went off duty, what it means is your 14-hour clock would beat you.
Yeah.
Right, because you've got it. You can't drive after the 14th hour. Essentially, it means that you might miss your delivery window that day. So there's a time component that adds a substantial cost. And over the course of the week, you may lose half of a trip or a complete trip. And I think that's why a lot of carriers look at it from a time impost perspective. And of course, then there are the other drivers that do have great equipment that just don't want to be out there. They can afford to take time off. So that's sort of the net of it. You do see carriers take time off, but you see refrigerated carriers take more time off typically than dry van. And I have a theory that's sort of backed up by what drivers talk about, and that is the 150-mile ag haulers exemption. And essentially in the produce market, that means that you can do multiple pickups within the 150 miles, but not record on-duty driving status. That's why you see 4 and 5 pickups per reefer load of produce across multiple farms, not recording any activity. Now, I know a lot of drivers that push that window excessively and routinely. And I think one of the theories I've had and drivers have told me is they just don't want anybody looking at the paperwork side of things, because your bills of lading would tell the story. Because nobody's really checking exactly where those loads are being picked up from unless you look at the bill of lading.
Right. Yeah.
And of course, flatbed, every time we see load securement as part of the road check week, flatbed, it's immediately obvious if you've got insufficient straps or chains on the load. So we tend to see flatbed carriers take time off at a higher rate also. So the amount of carriers that are taking time off really depends on the area of focus. But I do think this year we're probably seeing a much higher level of focus on carriers because of what's been going on in the media around CDL holders, English proficiency, accident rates. The general media buzz has been fairly anti truckload carrier in particular. So I think that's part of the reason we've seen a much higher level of carriers taking some time off this week. But they'll be back at it again, of course, next week. But I think the trend I've observed, Chad, is the authorities are also not just doing this during road check week. They're doing it a lot more often and having blitzes on other highways infrequently. And of course, they'll have brake safety week, and then they'll have a random day during the year where they'll just have a blitz without telling anybody.
Wow.
But what I'm noticing is there's more of these occurring that are random.
And
So
these blitzes will put you out of service. Well, not out of service, but take up 6 hours of your workday
yeah,
as well. Yeah.
yeah, because they're 6 hours is probably an extreme. I think maybe 4 hours is probably more like the average.
Okay.
But yeah, you'll have an impact there depending on where you're running.
Yeah, and I would expect it would have knock-on impacts too with the truck parking around that area because you got a lot more
Yeah.
carriers having to take their breaks. Yeah.
Yeah, and most of these are in public rest areas, like where there's not an abundance of space. So
Right.
you do see, and I've been involved in one where you have a bank up of carriers all the way up the interstate in the right-hand lane. It does
Right.
become
Yeah.
quite dangerous at times. So
Yeah. Yeah.
yeah, it's an interesting week. But again, it's one of those seasonal things we can count on that will have an impact on rates and drive.
Right. Right. I'm curious if you've heard any buzz around the English proficiency executive order, if that's having any impact. I wondered if that was going to cause some drivers to stay home this week.
Part of it.
Yeah.
I'm sure, Chad. I'm sure. But as I've said before, I said on the podcast with Carrie and Ken a couple of weeks ago, I think those carriers that might have had English proficiency issues, whether they be immigrants or American citizens, because remember, 1 in 5 Americans is considered illiterate. That will include a lot of truck drivers who aren't new to the country. They will get caught up in this if it's done properly. But I think the reality is, if you are a non-English speaking person, and again, I just don't believe the numbers, you're somehow driving a truck and you couldn't speak English despite having to go through a litany of tests to be able to speak English. I think they would have already disappeared out of the industry back in early March when all of this blew up on social media. Yeah. So the idea that we're going to suddenly start checking people and issuing out of service violations doesn't make a lot of sense to me, because why would you be out there driving into road check areas if you still couldn't speak English, knowing that that was one of the areas they were going to focus on? Right. I'm an immigrant. I have a very strong expat network. We communicate regularly. I'm sure all of the other folks that are new to the country and from other demographics or minority groups would have had the same thing. Sure. And would have said, let's avoid Arkansas, where it blew up in March. And then I think a lot of carriers would have said, this is enough's enough. So I just don't think we're going to see the impact that a lot of people are thinking it's going to have. Because as we reported last week, we're seeing more and more carriers join the market in April as compared to other Aprils. So we're seeing a surge in new capacity into the market on the spot side anyway. Yeah.
Yeah, it's surprising, these additional surges of capacity when spot rates specifically are so depressed.
Yeah. Well, it's interesting. Depressed, yes, but relative to what leased on carriers are getting, they're actually getting to a point where it'll be worthwhile to become an independent contractor. Because you need, as large carriers reduce leased on power rates because rates are lowering, it lowers the break-even point. Because if you need, if leased on is $1.50 and you need 50 cents a mile to run your own authority, line haul rates need to be about $2 a mile. Well, we're not far off that right now. Yeah. So what we're actually at is an inflection point that makes sense economically to go from leased on company driver to your own authority and start to run as an independent. We haven't seen that since March of 2022. Right? Because since March of 2022, it's been more favorable to be leased on or a company driver.
Right. So how do you see the next couple of months playing out? We just had road check. We're going into a holiday weekend. We've got this port slowdown that's hitting this week, I believe. That should be slowed down until Father's Day. And then we'll have, the June and early July surge of freight that's typical. How do you see the next month or so playing out?
Yeah, we're going to see the drop-off. This air pocket that people have talked about is certainly coming through the market right now. But there's, if I go back and look at the number of vessels that come into Long Beach and Los Angeles, and I'll start there because about 50% of the volume that comes into those two ports comes from China. So it's the best way to read. If you go back and look at the number of daily vessels that land in Long Beach and Los Angeles, long-term, going back pre-pandemic, it's in the 40 to 45 vessels a day are making port calls. In the last 6 months, though, it averaged about 60 and bumped up to 70 to 75 a day in the last couple of months as imports were surging in. It dropped back as soon as the Liberation Day announcement was made. It dropped back to about 45. It's been hovering around. It bumped up to 52 last week when the news came through of an impending trade deal. It's dropped back to around 38 to 40 per day. So that's an interesting data point, because I would have thought it would have continued to escalate and we would have seen more vessels on the way. What's really happening is this tsunami of, or mountain of containers that were sitting waiting for some sort of announcement, loaded and waiting, hit the water early last week, and that's what we'll see start to arrive around Father's Day. So I think what we'll see is a spike in volumes, and then you'll see it about a week to 10 days later on the East Coast as that volume comes in. But I think the data point I'm watching is what Gene Soroka at the Port of Los Angeles talks about. He's talking about the long-term structural damage of a 30% tariff on imports, which is still very high. His view is that he will see import container volumes drop in the order of 30 to 35% long-term. Wow. So if you've got a port that handles 50% of the volume is from China and you're expecting tariffs to have a long-term impact, that will disrupt the dray carrier market. You'll see less volume there. You'll see less truckload volume moving inland. But I think from a shipper point of view, what you'll start to see is this air pocket where we've seen fewer ships in the last month. There's 30 to 40 fewer ships that have taken empties back to Asia. Wow. Right. And remember, for every 4 loaded that come in, 3 go back empty. They need those empties back in Asia to reload for peak season.
Right.
So we're going to see chassis availability issues coming up shortly. We're going to see empties not available. And what shippers will do, or the ocean carriers will do, is they'll start to put surcharges on the international boxes and try and stop them going further inland from Los Angeles, because they want to turn them and send them straight back to Asia. That will mean we'll have fewer containers inland for exports.
Oh, wow. Yeah.
So
another knock-on effect. So
this is a repeat, but at a lower level of what we saw during the pandemic. So I think from a broker carrier perspective, my sense is a lot of market volatility, especially, and if the 30% tariff stays and shippers have to find other sources of their inputs into their manufacturing processes from either North America or somewhere domestically, we'll continue to see new lanes pop up that aren't in routing guides. To your earlier report about, RFPs being negotiated on lanes last year. Yeah. That's why I think we've seen a lot more activity in the spot market recently, as all these new lanes popping up as shippers find new sources for their inputs.
Yeah, it does remind me a lot of the pandemic. Even the on again, off again, restaurants open, restaurants closed. Right. It changes shipping lanes, and that causes a lot of volatility, and it feeds the spot market, which is good for the underlying carriers.
We love volatility in the market. There's opportunity for carriers and brokers in particular, to show their ability to be, clever logisticians. So we're in for some volatility. What that means in the second half, of course, I'm not sure. What I am sure of is an early peak season. So the second half looks somewhat subdued, I think, in terms of demand. Now, that could change if we start to see the manufacturing side of our economy really get some legs, but there's no sign that that's happening just yet.
Yeah. Well, it'll be super interesting as this summer progresses. I think the tariff pauses are scheduled to end in August, so time will tell.
Yeah. All right. Good discussion. Thanks, Chad. Couple of call outs. The ACT Research Market Vital Seminar number 73, August 20 to 21 is now open. Registrations are open for the Columbus, Ohio event. I'll be there speaking. Go to actresearch.net. Professor Kaplis is talking to Jason Miller. Great get in terms of podcasting. He's talking about how the market is behaving. That's out on the Freightvine podcast. We've got Brad Bentley from Fastport on next week to round out Vets Month at DAT. Make sure you set up alerts for our live shows. Subscribe to our channel. Thanks for being with us today. Another show is in the books. Thanks for watching. Be safe. Be nice to everybody. And we'll see you next week at 10 a.m. Eastern, 7 a.m. Pacific.